more. Into the Pits with Phil's daily live webinar classroom. Get inside market guidance on investing strategies. Find out more at philsgang.com or call 877-600-GANG. That's 877-600-4264. Don't have time to analyze and study stocks? At philsgang.com, we recognize that there are all types of investors, and we also recognize that your time is valuable. So we offer investing programs for all individuals. We offer investing programs for long-term and short-term positions.
With your host, Phil Grande.
What is coming to me?
Gang.com. Okay, we've been helping folks just like you since 1998. The retail investor. We help you maneuver the market, learn how to sell short as well as going long. That's really the key. When people don't short stocks and just go long, it's very difficult to make money. And that's why 90% of the retail investor loses money. Isn't that crazy? That's nuts. But it's the truth. 90% lose money. If you give your money to a broker, your 401k and all that, you still lose money, sometimes more, because they have to play by the rules. Like, for example, when you have rising yields, and example, we had some rising, they just started to go the other way here, but when yields were rising, what was your 401k manager doing? Well, he was taking you out of tech stocks and putting you into value stocks. So while value stocks were soaring, okay, your tech stocks soaring rather, he takes, those are growth stocks, he's got you into value stocks like Coke and Pepsi and those sort of things, and you're not making money. But this is how they work on Wall Street. To try to make you feel safe. There's no such thing as safe. Again, you've got to learn that the market also is not a place to go gamble. I always refer to people who we call them retail folks, but we call them tourists. They have a gambling mentality. They're different than the retail investor, okay? So most of the people who trade, they're losing money, we call tourists, because they like to gamble, they like the risk, they have a gambler's mentality, and they lose all the time. The market is not gambling, okay? The market, again, is all about strategy, following the money. Years and years ago, you follow the fundamentals, and the reason you follow fundamentals is to follow the money. Those days are gone. I mean, those days are gone. This whole thing with IT is insane, what they've done with this IT. Matter of fact, it's interesting. I was reading an article over the weekend that the Magnificent Seven companies are investing a record $100 billion per quarter in AI. What are you, nuts? I mean, we are in a chip revolution. And Jeff Bezos, it was funny, he described the AI chip revolution as remnants of the dot-com bubble, and he's calling it, even a bigger bubble. He's calling it a manufacturing bubble, and he points out just how dangerous it is. Now, when you have the S&P making 57 new highs in 2024, and you have so far, the first 6 months of this year, we had 30 all-time new highs. What are you, nuts? It's crazy. And all these fake business news networks and these jibber-jabbers, on Friday they came out and we had that rally and they're excited and they said, we have now a renewal enthusiasm, okay, of IT, because just a week earlier, the MIT report came out and said, hey, this is not working. they revealed that 95% of the companies investing in the AI sector are losing enthusiasm because they don't see any returns. Matter of fact, there's a big disconnect between spending, all this AI spending, and proven returns. And as for Bezos says, again, this is nothing but another a big bubble. And what's interesting is that when you have the hype, and think about the hype, that's all it is. When they come out and they say, okay, we got this company investing $100 billion, this company investing $200 billion, they announce that and boom, the S&P shoots up, another new high every time. So all they got to do is keep announcing more investments, right? The other day we had Oracle, then we had another one, I forgot who it was. Which one was it? Just went with AI Open. It was OpenAI. Who was it? AMD, yeah, AMD. They just did a deal. And AMD just screamed up, but not because of profits. So what's happening is this bubble, and this is what it is driven by this hype of, hey, we got another investor, the startup, we're going to put billions into this company. But there's no returns. There's no returns, and people are just piling in. So the reality is that the hype, these announcements, are much larger than the profitability of these companies. So what's going to happen? How long do we keep with this hype? Oh, that company's putting in $200 billion. Oh, this company's putting $300 billion. Oh, this company's putting $100 billion. Oh, wow, look at the stock market. It's up 75% today. I mean, and there's no earnings. Nobody cares about earnings. Nobody cares about profits. It's just, did somebody else invest another $100 billion? So in the meantime, this can go on for a long time. I talk about it all the time with my gang members. Don't think this thing is going. This is much different than the dot-com days. Okay, much different than the dot-com days. This hype has nothing to do with earnings. No one cares about incoming, generating all this income for your business or profits. Nobody cares about profits after you pay your. They just don't care anymore. Stocks will go up without profits, without earnings, without productivity. Think about that for a moment. A stock price will go up without profits, without earnings. That's amazing, isn't it? And who's making all this money? The guys on Wall Street, the top 1 percentile. And they, I mean, it's just amazing the money they're making. But isn't it wonderful? You don't need to have profits anymore. So it's really all based on hype. The dot-com, yes, was based on hype, but not to this degree. Not to this degree, where you just got to make an announcement. I mean, look when Oracle made that announcement, $300 billion, bam. But isn't it interesting, though, 2 weeks ago, MIT puts out this report, as I said a moment ago, that was very negative, this AI investment. Bezos was talking about it. But nobody cares. They just can't wait to buy these tech companies. And again, it's not a whole bunch of stocks. It's just a couple stocks that are driving this whole thing. You don't have like 30, 40 stocks. Wasn't like the dot-com days. You have a few tech stocks. That's AMD, Oracle, Micron Technology, NVIDIA, just a few stocks. So when one of those crack, you're going to have one hell of a break in the market. But until then, enjoy these rallies. Protect yourself. When they make an announcement, make sure you don't chase them. You already got to be in the stock. And then when the announcement is made and the stock goes up 15%, 20%, 10%, you sell into it. So you got to be in these stocks before these announcements. Now, and that's why we call tourists, we call them tourists, because they're always chasing. Tourists always chase. Investors don't chase. Investors sit back and let it come to them. Just like example, we have a portfolio of 6 stocks and our new gang members follow our portfolio. And once you're done with your 10 days, if you want your own portfolio, go ahead, or you can continue following our portfolio. But the point I'm making is that you got to wait for the setup to come to you, the buy signals to come to you. There's only a handful of buy signals. That's it, just a handful, about 5. But if you're always looking for that hot stock, and you're looking to Kramer and all these other guys, they got a hot stock, you're never going to make any money. Oh, you'll make some scores, but you're never going to retire. You're never going to have a nice portfolio. Everything you get a couple of hot hits, and then you give it all back. So again, the hype is turning out, and I was so glad I read this, because he said exactly what I've been saying. It's all hype. Once that hype moves, it's over. But the thing is, it's different than the dot-com days, because this hype can go on for a long time. And as long as Wall Street makes sure they keep increasing margin accounts so that the retail tourist can keep borrowing money to keep buying these same tech stocks over and over and over, and they don't care how many people will fall into bankruptcy. They could care less. They're making a fortune, these people. And they're using the retail tourists. They're using them. They're hurting them. Okay, giving them all this credit. Like give them a credit card with no limit. That's what's going on with these margin accounts. So you got to be very, very careful. So the dot-com days were different, okay, than the AI investment. And because the AI investment has this electric feeling. Also, when you hear, oh, there's going to be another, 100 billion, Trump brings somebody to his office, oh, this guy's going to put in 200 billion. It has an electric feeling that we didn't get with the dot-com days. Dot-com days were different. Dot-com days, the scam was you would have CNBC, and the company would come out public at 5 o'clock. Come out at $5, and then Kramer would be pushing it. And I can't remember the guy who was back at CNBC. He's still on TV today. He's still at CNBC. And boy, he'd be pumping it. These two guys would keep pumping. All of a sudden, the stock's at $80. Now, this is different this time. This is much more dangerous, okay, this AI revolution we're in. Because, again, if you think about the percentages, think about this. You got gold. There's a reason gold's up 50%, but the S&P's up 32%. There's a reason gold's up 50%, but Nvidia's only up 36%. There's a reason the S&P in the last 6 months is up 39%. But gold is up, and silver is up better than the S&P. Why? Because the professionals aren't buying into this hype. They're selling into the hype. They're selling into the hype. So all these stocks, you can't chase these rallies. You have to already been in them, and then when you get the rally, you start taking your profits. Now the S&P, as I say, you got they think about the S&P 500 is up 39% in 6 months. They added 16 trillion to their market cap. What are you nuts? This is insane. Then you have guys like this here. This is unbelievable. This guy here saying how, let's see, I think this is the one. He's telling you got to be in stocks. Let's see what I have it here.
So on all the companies we're seeing today, what we're seeing is there's a greater need for capital. Mm-hmm. And the simple reason for that is because people are having issues, right? So I think if that continues, you are going to have a mini recession, but I think the fact that the Fed is lowering rates might end up staving off that recession.
No. When they keep lowering rates, that creates a recession. That creates inflation as they keep lowering rates. When the Fed keeps lowering those rates, that's inflationary. Because when you lower rates and all of a sudden you stimulate buying, you stimulate consumption, people go buying cars, stuff like that, that's inflation. That's what we don't need right now. And another one he's talking about is, I think, I'm trying to find the one he's talking about was stocks. I don't know, right here, I think it is.
If you own stocks, you're doing fine. If you don't, you are really stressed.
Now think about this. If you own stocks, you're doing fine. Really? And if you don't, you're stressed. Those are the people they go after. Those are the people who are mad. They're angry. They missed the move. They missed these big moves on NVIDIA. Those are the people that keep the market going up. Those are the people that are tourists. They're the ones that buy at the very top. And they keep buying because they're angry. They missed the move. And the market keeps going up and up and up. And the bubble gets bigger and bigger and bigger. And then, again, you go back and look at the margin accounts. They keep expanding. They're buying stock on credit, buying stock on credit. So, but as this thing is going up, you stay with it. You don't get out of it. You just got to identify when the market's going to turn against you. We'll talk about that when we get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
If you want to invest your money and grow your wealth, listen to this.
Hi, I'm Phil Grande at philsgang.com. You know, I get so tired of listening to the same garbage every day, listening to the fake business news network telling you why you should buy this stock, why you should buy, and they're always wrong. Join my gang, philsgang.com, free for 10 days. You're going to learn when to buy a stock and when not to buy a stock. Hey, years ago it was different. You could buy a stock based on fundamentals. You could buy a stock based on earnings. You could buy a stock based on PE ratios. Those days are gone. That ended with QE. That ended when they financially engineered the market in 2008. Gone. Now you got to follow the money. And we have the knowledge because we have the chart. Pro 2 color-coded chart tells you when to buy, when to sell, when to run like hell.
For a limited time, you can join Phil's Gang free for 10 days.
Check it out, philsgang.com. Get the truth, get the knowledge, and understand how the market really works.
Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
You know, we have a terrible dollar. It's getting weaker and weaker. And remember, that really hurts because your weak dollar, everything we import costs more. The weak dollar, okay, as I said, it's very inflationary, very inflationary. And when they keep cutting rates, that's inflation. The problem is when the Fed told us, Powell said he's doing all this, he's going to cut rates, okay, because again, he wants to help the labor market. No, the labor market's getting worse and worse and worse. He should be raising rates to fight inflation. If he keeps doing this, we're going to have a crack. And again, remember, what's going to take this market down is when there's a crack in the margin accounts, or there's a crack, always starts first with the stock buybacks. When the stock buybacks when the CEOs right now, they have historic amount of debt, because all that debt is related to their stock buybacks. The day they stop, okay, as interest rates keep going up, and that's why you got to watch the yield like a hawk. Got to watch that 10-year yield, and it's on its way back up. Remember, there's hedge funds right now that they're shorting the hell out of 10-year Treasury, trying to push it down, push it down, push it down. It's not working. For a couple of weeks it did, but now it's on its way back up. They can't stop it. Right? Our inflation, when he says we're going to cut rates for corporations so they'll start hiring people, that was such BS. What a lie that was. You cut rates, you don't start hiring people. When they cut rates, they want to see the consumption first. If I'm Nike and you cut rates, I want to see first sales going up. Then we'll start manufacturing. That's a BS lie, all of that, okay? Again, the hype that we're cutting rates makes the market go up. Makes the market go up. That's why they use that. Just like the hype that we're going to invest, some companies going to invest another $100 billion, makes the market go up. So everything that's making the market go up doesn't work. It's just the bubble. It doesn't work. What works is when you print money, give it to companies, lend it to companies, so they do productivity, increase productivity. When you increase productivity, that works. Because when you increase productivity, then you start creating jobs. Okay? That's when you start creating jobs. And we are not increasing our productivity. We haven't increased our productivity, in 10 years? Because everything has been, again, zero rates, stock buybacks. So now, if you look at the dot-coms, there's 2 of 5 stocks that are driving this whole rage, this whole rage of AI, NVIDIA and Broadcom. Those are the 2 stocks. There's about 6 stocks that are driving, but those 2 are the main drivers, okay, of this AI. So you got to keep an eye on those 2 stocks and watch for the message from the market, from these 2 stocks, when they're going to start going down, so you can start shorting. The most important thing right now is stay with these tech stocks that keep going up, continue to make your money. But again, if you're getting in now at the top, like this guy said, they're frustrated, they're getting in. No, they always get in the wrong place at the top. If you got in properly, if you got in what we call the sweet spot, every stock has a sweet spot. If you got in when you're supposed to get in, every time you get these rallies, you sell more shares. You sell more shares. And who comes in behind you to buy those shares? Not the institutions. They're dumping. You have the tourist investor who's a pure gambler, and he's buying. So right now, all we see is these 2 stocks keep going up, 5 of them, but you look at NVIDIA and Broadcom, they're leading, okay? They're leading. I mean, they're up 37% and 47%. Think about it. NVIDIA's up, I think, 33, and Broadcom is up 47%. Can you imagine? This is insane what's going on. Now, and what's happening is, as I said, when you increase the money supply, keep increasing that money supply so that the corporations, CEOs can keep buying their own shares. And then, these stock buybacks. And then when Powell comes in and says, I'm going to cut rates, that's the key right there. The concoction of nonsense is all he's got to do is you can get the market rallying by saying we're going to increase the money supply, we're going to start cutting rates, okay, and that will move the market. And then you turn around and say there's going to be enough money to increase the margin account so you can borrow money to buy NVIDIA, to buy these stocks as they keep going up. So we're in that point right now of again, this in the la-la land. We're in the point okay, on a chart where there's no rationale anymore. People are just diving in and getting these stocks, and they're ignoring valuations. The valuations of these stocks are totally insane. We didn't look at .com was bad enough, but you take these AI stocks, nobody cares about the valuations. They're all ignoring the valuations because the market doesn't come down. It never comes down. As long as we have that tourist investor picking up the stocks from the institutions, from the hedge funds, from the large pension funds, from the 401ks, from the banks, from the insurance companies, they keep dumping. As long as you have the retail investor, okay, I'm calling him the terrorist or the tourist, and as long as they're there and they're ready to play, and they just keep going in deeper and deeper because they got credit, then just let's stay with those stocks. We've been with stocks, I'm going to show you right here. It's amazing. If you take the stocks that we've been with, okay, if you go down, and this is where all the action is. NVIDIA, okay, is a chip stock, right? And it just keeps going up. Your and you got your the AVGO, okay, that stock is just going straight up. We got into that stock, AVGO, back in April 30th, I think it was, 2025. I think that was around at that time when we got in. I think it was around $190, something like that. Today it's up over, what's it, 300 and some odd dollars. Yeah, about 336. Now, when we got into the stock, you can see on your chart, on this called our Pro 2 chart, it stayed green. What that does, it tells us that it's telling you the pricing of the stock. Money is going in. So you can see it's going into the pricing. They're pushing the pricing up. There's enough money behind it. When that lightens up, it'll turn yellow for us and warn us that there's some profit taking. The institutions are taking some profits. Then when it starts turning red, it tells us they're selling, but they haven't been selling. Now, as of the last, if you take from last week, let's see if I'll go and try to pick this up again. Yeah, if you go back to, not last week, but to September 11th, it's been pulling back. And if you look at the volume, you're starting to see a lot of selling coming in. What does that mean? That means you got the institutions, that are dumping these stocks. And then what happens, instead of them dropping and continue to go down, they'll go right back up because you have the tourist investor, the gambler, he's going to come in and he's going to keep buying these stocks until they don't. So if you look at the MAGs, you look at ARC, you look at, these are all stocks we've been in. And if you go down to your most, this is another one we've been in right here is let me get them for you. I mean, we've been doing really good with the tech stocks here. Here we are. So the chips, this is where the money's been. NVIDIA, AVGO, AMD, the ETF, SMH, Taiwan Semi, TSM, MU, Intel. This is where all the money's been going. That's where all the money's been going. So we've been in those stocks and we've been in gold. Well, how is it these tech stocks are going up through the roof and gold? Gold is sending a message that there's going to be one big blow up one day. Gold, everyone's going to go, all the central banks are going to go. They're not taking, when they sell us stuff, they're not taking those dollars and going to the auctions and loaning us money. What they're doing is taking the dollars for stuff that Japan sells us, China sells us, and by the way, our dollar is so bad, okay? Our imports are insane, what we got to pay for stuff, right? The inflation's crazy. So, but what's going to happen eventually as these prices keep on going higher and higher for imports, he can say all day long, Powell, I'm going to cut rates, It's not going to work. It's not going to help because we have record bankruptcies already, personal bankruptcies. Record personal bankruptcies. It's not anymore about, I'm going to cut rates and I'm going to save the world. Matter of fact, they even said in here, let's see,
So on all the companies we're seeing today, what we're seeing is there's a greater need for capital. And the simple reason for that is because people are having issues, right? So I think if that continues, you are going to have a mini recession. But I think the fact that the Fed is lowering rates might end up staving off that recession.
What a bunch of nonsense. The Fed cutting rates is causing a bigger problem. The Fed cutting rates is causing the market to collapse. It will collapse because they shouldn't be cutting rates. They should be raising rates because of the inflation. It's terrible. Just think of all the stuff we import. Think of Walmart. And look at those stocks. Walmart and Home Depot and Lowe's. That's one of our discretionary stocks. Look at Costco. Okay, Costco's been a beautiful short. Costco. It's below all three moving average, a perfect short. You got to learn how to short. Walmart. Okay, that's getting ready to short. Walmart's if Walmart drops below, let's say below $99, okay, this thing is going to start tanking. So what's happening is Walmart, Lowe's, okay, they're all in trouble. Costco, because when they import their goods, they're too expensive. And people they don't afford them. They can't afford them. And he can lower rates all he wants. That's not what we need. What we need is to raise rates. We need to raise rates, take some pain, and then get rid of the inflation. What we need is stop this insanity with stock buybacks, because all that money for stock buybacks is all printed money. That's got to stop. Stock buybacks, you want to fix this economy? Stock buybacks, outlaw them. Outlaw the stock buybacks. You'll have one of the biggest crashes in history. The only thing that's holding up this market is stock buybacks. And look at the pricing of stocks. You can't find a decent stock anymore for $75 or $50. I remember when everybody was looking for a stock under $50, under $25. Those stocks now are $275, $300. How the hell did they get from 55 to 300, 55 to 275? All inflation. As long as you keep printing money and give it to the CEOs for zero interest rates or near it, and they buy their own stock back, the price of stock keeps going up. Not because of demand. Price of stock's going up because they take the stock when they buy it back and they don't put it out there for sale. See, people don't understand that. When you have a stock buyback, if you have 1,000 shares and you buy your own stock back, okay, 100 shares, that stock doesn't go back into available inventory. That's gone. So now your shares, the amount of shares you have drops, and then their price goes up. Then they do it again. And what they do is they keep on dropping the amount of shares outstanding to push the price up. That's where your inflation's coming from. And it's just crazy. So, but as long as you know what you're doing, you know how to go long, you know how to go short, it doesn't matter what these crazy people do. You'll continue to make money. You got to know what you're doing. We'll help you. Check it out, philsgang.com, free for 10 days.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.